Welcome to Studio B again. I think I gave up on Studio A. Bonds. What type of bonds are there? There's municipal bonds. Cities need to build a bridge. They don't have all the money right away, so they'll sell you a bond. They have certain tax advantages on a municipal bond. So you're thinking, well, yeah, that's good. No taxes in certain states and cities because of a bond. Whether it's a 5.5% yield, a 6.5% yield, a 10.5% yield, a lot of people are attracted to the safety of bonds. The federal government has bonds. They'll want to sell you a bond so they could use it for whatever. Certain companies have bonds. They'll sell you a bond, and then you buy their bond, and they'll pay you some interest, and they'll pay you your capital back. Personally, I am not into bonds at this time. So why? Yields are better in the stock market right now. The only possible exception to a bond that I would look at may be what they call a junk bond that maybe pays 15 or 20%. And then you got to find out whether that particular company that issues it is a good enough risk to purchase the bond. A guy from Walmart, who was Filipino at one time, had told me that he made money in junk bonds. I can believe it. If they're going to pay 15 or 20% yield, and a junk bond is 18 months or a year or less or something like that, they want to buy and build a factory, or they want to build something, and then the yield is going to be actually paid to you. Short-term junk bonds might be a good investment for you. At this time, I haven't bought any junk bonds. I haven't invested in any municipal bonds. I haven't bought any bonds that have anything to do with the federal government. A lot of people say, I'm going to sell my stock and get into the safety of bonds. Are bonds safer? If they're only going to give you 1 or 2% yield, I would not want to be in that. My base is 5%. I like at least 5%. If there's an ETF that's buying if there's an ETF that's going to give you a 5% yield, 5.25, it's TGIF, I believe, does that. They pay actually weekly. You can compound the interest back into the same ETF. Why not? By the end of the year, I don't know if it's going to be 5.5 or 6% if you continue to put your dividends right back in, because it compounds. If there's another ETF that's paying, monthly, that might be okay. If there's another ETF that might pay quarterly and the yield is over 5%, that's not a bad deal, maybe. Stocks pay monthly, stocks pay quarterly. I prefer stocks. I like stocks. Well, the yield goes up and the equity position may drop right now. Well, yeah, the equity might drop, but the yield keeps coming in. They keep paying and paying and paying. From my perspective, the market eventually will replace your equity. Eventually. Unless the stock is just no good. Long term, or the stocks usually go up 10% a year. That doesn't mean they will always go up. What happened in the past doesn't have to happen in the future. In general, long term, in my opinion, the bear market, what they call a bear market, which is dropping by 20% or more, the market eventually, in my opinion, should reverse itself, and then your equity will go back up, and then you have a high yield, and you also have your equity back. It's not guaranteed. But bonds, in general, pay less of a yield to me. I'd rather buy an 18% yield than a 5.5% yield. Personally, a lot of people abandon the stock market and go into bonds for safety. Some people do both. Kudos. Good for you. You want to get some yield from bonds, and you want to get some yield from stocks. Good for you. Some do a 60-40, 40-60. 60% stocks, 40% bonds, or 60% bonds and 40% stocks. I want something that I can hold forever. A bond is going to be issued for a specific amount of time. I don't like that. Even if it's 2030 and today is 2023, 17 more years. Okay. I would prefer something that does not have an endpoint to it. That's my personal preference. Now, if I'm going to make 20% in a year by buying a junk bond, and I like the company, and I like what they're doing, and I believe that they're going to be able to pay the 20% or 25% or whatever it is, or 17% or 15%, I would consider it. Because I'll get my equity back, and then I'll get the income back. So for 100%, I get 120%. Okay. Not a bad deal. If it's a good company and if it's a good yield. In general, I'm not looking at municipal bonds. I'm not looking at federal bonds, which have a tendency to be under 5%. And even if they're over 5%, how long do I have to hold them? And do I get my equity back? I really don't like trusting the government on anything. But they are, in general, super, super duper safe. Any more questions about bonds? Now, if you want to know what a municipal bond is in depth, let me know below. If you want me to explain federal bonds, go ahead. Put the comment down below, and I'll go in depth on that. If you a corporate bond, in my opinion, I would rather have a corporate bond than a municipal bond. You still have to pay taxes, but still, I have more faith in more companies than I do the federal government, because they're going to tax you anyway. So, in general, I don't like bonds. Particular bonds could convince me to buy them, but at this point, not right now. I haven't never bought bonds right now, and I'm not interested in bonds. I'm interested in stocks, ETFs, things that I can hold. Have a great day.